Kansas City is full of homes carrying a mortgage in the 3% range, and a VA loan assumption lets a buyer take that loan over, rate and all. Not a refinance, not a rate buy down, the actual existing loan at the rate the seller locked back in 2020 or 2021, while everyone else is shopping at rates more than double that. And people have figured it out. VA loan assumptions are up about 20 times over the last 3 years, but last year still only about 6,700 of them closed in the entire country out of more than 500,000 VA loans. Massive demand, tiny finish line, and the space between those two numbers is this video. I'm walking you through how an assumption works from both sides of the table, buyer and seller, what separates the deals that close from the ones that fall apart, and the trap in the middle that lands on the veteran seller, the one person everyone assumes is winning. I'm also going to answer a question I watched a veteran ask online. How much cash does it actually take to assume the loan on a $279,000 house? People in the comments were guessing all over the place, and most of the guesses were wrong. I'll give you the real math before we are done, so stay with me. If we've not met, I'm Joe Nelson. I spent 21 years in the Air Force. I lead the Nelson Home Group at Keller Williams KC North, and I'm both a realtor and a licensed mortgage originator. That combination matters on this topic because an assumption is one of the few transactions where the real estate side and the lending side collide head on, and I sit on both sides of the table. And I will tell you straight out why I make these videos. It's because I actually want to work with you. If anything in this video raises a question about your own situation, call me or shoot me an email. My contact info is right below the video. Let us start with what an assumption actually is, because the word sounds more complicated than the concept. When you assume a VA loan, you step into the seller's existing mortgage. Their balance becomes your balance. Their rate becomes your rate. Their remaining term becomes your term. So if they're 5 years into a 30-year loan, you're taking over the remaining 25 years. You're not applying for a brand new loan, you're taking over an existing one with the servicer's approval, and the loan keeps its original terms. Why would anyone fight through the extra steps and paperwork for that? Well, the numbers. For the math today, I'll use 6.75% on a new loan, and understand that this is a rough number on purpose. Your actual rate depends on your credit, your down payment, and the pricing adjustments on your specific application. So treat this as a comparison, not a quote. A veteran who bought in Kansas City in 2021 might be sitting on 2.75% interest, or maybe even 3%. On a $300,000 balance, principal and interest at 3% is about $1,265 a month. That same balance at 6.75% runs about $1,946. That is nearly $700 a month on the same house, same loan, same everything, except the rate. Stack that up over 5 years and you're past $40,000. If you want to run your own numbers on any price and any rate, use the mortgage calculator on my website linked below this video. It will also calculate the exact VA funding fee for your scenario. Speaking of the funding fee, the fee structure on an assumption is friendlier too. A veteran using a VA loan for the first time with nothing down pays a funding fee of 2.15%. The funding fee on an assumption is 0.5% of the loan balance. On that same $300,000, that's only $1,500 instead of $6,450. And if you're a veteran with a disability rating, that exempts you from the funding fee altogether. That exemption does apply here too. Hold that thought if this sounds too good to be true, because what the seller gives up should change how both sides negotiate. That part is coming, and it matters most if you wear the uniform. First, the buyer's side. Who can assume a VA loan? I'll bet you didn't know this, but almost anyone the servicer approves. You do not have to be a veteran. You do not have to be military at all. A civilian buyer can assume a veteran's VA loan, and that surprises a lot of people. What you cannot skip is qualifying. The servicer checks your credit, your income, your debts, and a lot like they would on a new mortgage. The rate is inherited, the underwriting is not. Here's the piece that stops most buyers cold: the equity gap. You're assuming the seller's loan balance, and the balance is almost never the same as the price. Say the house sells for $350,000, a touch above the Kansas City median. The seller owes $250,000. That's $100,000 difference in the seller's equity, and it has to be covered at closing, in cash or maybe with a second loan behind the assumption. There's no zero down magic on the gap. This is the #1 reason assumable mortgage deals dies, and it is also your filter. A seller who bought in 2021 with nothing down and has a modest gap, that is the sweet spot, and Kansas City does have a lot of those. Now, other videos will tell you that if the gap is bigger than your savings, you just get a second loan behind the assumption and finance the difference. Let me give it to you straight from the lending side because I am a licensed originator and I cannot write that loan. The VA allows a second behind an assumption on paper, but most lenders will not take a second position behind a loan they do not control. So in the real world, that financing barely exists. One national marketplace product does it, and even that caps total borrowing at 85% of the price, so the buyer still has to bring 15% to the table. Past that, you're looking at the occasional portfolio lender or hard money at terms that eat the exact savings you came for. So plan on the gap being cash, and if someone does offer you a second, run the combined numbers on both loans before you celebrate. This is exactly where having a loan originator in your corner earns its keep. While we are on practical matters, let me set your expectations on process because an assumption runs on the servicer's timeline, not the standard 30-day purchase contract. You will submit the same full financial package you would on a new mortgage, and even with a smooth case, plan on more than normal for closing. Build that into your housing plan, your lease, your contract dates. Write the assumption approval into the contract as a condition. Get your file complete before you submit it, and then stay on the servicer weekly. Squeaky wheel is a real strategy here. Now, I'm not guessing about the timeline risk because it cost me a deal. I had a listing where my sellers were sitting on an Assumable VA loan and a veteran buyer showed up who wanted that rate and had the cash to cover the equity gap. On paper, done deal, but the servicer told us they needed at least 45 and more like 60 days to process the assumption. My sellers had to be closed in 30 because of a relocation and the purchase on their next home. The math worked, the people worked, the clock killed it. That deal is why I tell you to build the servicer's timeline into your contract from day one. My deal was not the exception. A VA loan assumption has a reputation for being slow, and the reputation was earned. Servicers have let these applications sit for months, long enough that Congress finally got involved. A bill introduced June 18th of this year, the Affordable Homes for Veterans Act, would require servicers to decide on a complete assumption application within 45 calendar days. And it calls for an audit of how servicers have been handling these, including whether they've been quietly discouraging them. Now, that is a bill, not a law yet, so don't walk into your servicer's office quoting it, but it tells you where this is heading. The pressure on servicers is building, and assumptions are moving from a curiosity to a strategy. Now, the seller side. Veterans, this section's for you, and this is where the trap lives. If you remember one sentence from this whole video, remember this one. When someone assumes your VA loan, your entitlement stays locked to that loan until it is paid in full, unless the buyer is a veteran who substitutes their own entitlement. Every word in that sentence is doing work, so let me unpack it. Your entitlement is the amount the VA guarantees on your behalf. I've got a whole video on that, I'll link it in the description. It's the engine behind Zero Down. When you buy a house with your VA loan, that entitlement is committed to the loan. Sell the house the normal way and the loan gets paid off at closing, your entitlement is restored and you can use it again on the next house. But in an assumption, the loan never gets paid off. It keeps right on living in someone else's hands, and if that someone is not a veteran, your entitlement stays tied up to a house you no longer own. Read that again. Not until the buyer refinances someday maybe, or sells it, until the loan is paid in full, which could be 25 years on a young loan. Then it gets worse. The VA's own disclosure form spells it out. If the person who assumed your loan defaults down the road and the VA pays a claim, that loss has to be repaid in full before your entitlement is restored. If you are counting on your VA benefit for your own next purchase, letting a civilian assume your loan can shrink or sideline that benefit for decades. Some veterans do have what the VA calls bonus entitlement left over, enough to buy again with limits, but that is math you want to run before you accept the offer, not after. I've heard of veterans celebrating an assumption offer without anyone in the deal explaining this to them, and that is exactly the conversation this video exists to force. There's a clean way out, and it's called substitution of entitlement. If your buyer is a veteran with enough entitlement of their own, they can formally swap their entitlement in for yours. Your entitlement comes home. Their entitlement takes over the loan, and both sides win. So if you're a veteran seller with an assumable low-rate loan, a veteran buyer with an entitlement of their own is your cleanest exit, and that belongs in the plan before the house ever hits the market. And let me be blunt about the market we're in. Homes are not sitting. You do not need to hand a civilian your entitlement to get your house sold, and I would not recommend it. If the market ever tilts hard toward buyers, that calculation changes. Today, the only version of this deal I like for a veteran seller is a veteran buyer and a substitute of entitlement. One more seller item, and it's not small: the release of liability. When the assumption is approved through the servicer the right way, you can be formally released from liability on that loan. Get that release in writing, and if anyone ever pitches you on letting a buyer just take over your payments informally, no servicer approval, no formal assumption, walk away fast. Your name stays on the note, and your credit rides on a stranger's payment history for years. If you're a veteran in Kansas City sitting on a low rate loan and weighing a move, this exact trade-off, the rate you're handing over, the entitlement you might be locking up, and the price you should be asking because of it deserves a real conversation before you ever list. Call me or shoot me an email. My contact info is in the description. Let me put the Kansas City frame around all this because the local math makes it sharper. Our median sales price for existing homes in June of 2026 was about $335,000. Homes are averaging about 36 days on market, and supply is sitting around 2.4 months. Still tighter than balanced. Now, think about who bought here in 2020 and 2021. A wave of military families used VA loans near Fort Leavenworth, near Whiteman, and really all across Kansas City, and they locked rates most buyers are not going to see again. These exact loans are today's assumable inventory. Buyers, listings do not always advertise this, so make your agent dig. Listing remarks, agent-to-agent questions, a direct ask about the seller's loan type and balance. When a listing does say assumable VA loan at 2.75%, that one line can be worth more than a price cut, and you should treat it that way when you write your offer. Sellers, same coin, other side. If your loan is assumable at a low rate, that is a marketing asset, and we need to market it that way. An assumable mortgage widens your buyer pool right when higher rates are shrinking everyone else's. So let us close the loop I opened at the top, the $279,000 question. A veteran asked how much cash a buyer needs to assume the loan on a $279,000 house, and people were tossing out guesses. Here's the honest answer. The price does not tell you. The payoff balance does. If the seller owes $240,000, the buyer needs to cover a $39,000 gap plus 0.5% funding fee, about $1,200, plus ordinary closing costs. If the seller owes $150,000, the gap is $129,000, and this is probably not your deal. Same house, same price, completely different answer. So the first question on any VA loan assumption is never the price, it is the payoff balance, and now you know to ask it. I put together a VA home buying guide for Kansas City. It's the full VA playbook, eligibility to closing, and if you're even thinking about using your VA benefit, it is the place to start. Head to my website and sign up, and I'll send it to you for free. If you want to go deeper on this, I've got a full playlist on VA loans and VA purchases linked below. Here's the thing I'll say again. I make these videos because I want to work with you. It's the whole reason I do this. If you're hunting for an assumable rate or protecting the one you have, I would love to be in your corner. I'm Joe Nelson. Let's get to work.